Hello everyone, welcome to TBR's webinar, Application Software, Shifting Deployment Strategies and Shrinking Margins. I'm Justin Sargent and I'm hosting today's session. As the shift to a cloud consumption model accelerates, benchmark vendors' average license revenue shrinks to low double digits, while average cloud subscription revenue grows to mid double digits. Traditional applications vendors fight to maintain and grow market share and revenue streams in the software market that is undergoing drastic delivery model changes. Initiating go-to-market and sales strategy changes across the market, the transition from license to subscription application sales requires companies to invest strategically to drive long-term renewable revenue streams. The insights shared in today's webinar from our application software vendor benchmark. If you'd like to learn more about this report, please reach out to me or one of the analysts after the presentation. Now, before we begin, there are a few housekeeping items I'd like to cover. First, we'll be recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit our channel to view our previous webinars. Second, we'd like to hear your thoughts and opinions on the material we're presenting. Please send any questions to the Q&A function and we will address them at the end of the webinar. And third, we'll send out the slides to everyone registered for today's webinar within 1 business day of the conclusion of the presentation. You can also find the slides as well as our other webinars at slideshare.net/TBR_market_insight. And now let me introduce the analyst presenting today. Geoff Woollacott is a principal analyst in TBR software practice and oversees a syndicated research team for the software and BI services practice. Meaghan McGrath is an analyst here in TBR software practice and is responsible for analyzing the software and cloud businesses of vendors including SAS, Oracle, Amazon, Google, Rackspace, and ServiceNow. And Kelsey is an analyst at TBR's cloud practice and contributes insights for quarterly benchmarking activities, comparing the industry's top performers. She provides research and data analysis skills for TBR's public cloud benchmark and custom research reports and projects. And with that, let me hand this over to the analyst.
Thank you, Justin. What we'll go through today, this is a quick view of the webinar agenda. We'll always have that front-end piece of the content enhancements. There's so much going on that we're continuing to iterate and evolve these things, even though they come out on a quarterly basis. We're always extending them a little bit further. So in this one, if you listen to the prior quarter one, that was the first time we had them split. We've added subscription modeling for 15 of the 22 firms. The reason why we've only gone that far is for some of them it's a veritable Easter egg hunt to find out what's going on, particularly if they're a multi-line vendor, whereas for the pure plays, they need to be putting up proof points to send signals to the Wall Street community that it is indeed going well. And so we take those first because they give us sufficient guidance to be able to do accurate modeling. That then gives us kind of the guardrails for our estimates around some of the multi-line vendors. So we want to get to the point where we'll have all 22 split out this way. I'll tell you, some of the big guys are a challenge, and we're holding off because we just want to make sure we see it. The other addition was we added Workday to the applications software benchmark this quarter. Actuate merges into OpenText in 1Q15 because OpenText picked them up. So that's sort of where we are on the content enhancements. The core of it will be the overarching themes and insights by taking a look at the bubble charts that appear in the full benchmark deliverable if you're a subscriber. And then we have the overarching theme proof points. We touched, it was a big topic of discussion in the fourth quarter for these folks about currency exchange rates. We're talking about in-memory. You're going to wonder why in the apps we're talking about in-memory, but it's an adoption that requires the application proof points. And then thirdly, we're looking at the smaller vendors and how they're leveraging the CNSI partners, given the sort of disintermediation layer that's going on because of cloud-delivered technology. It also means app dev folks don't need the big investments, so there's a lot of little partners out there, and they need the blessing of these large CNSIs. So content enhancements for 4Q14, I hit most of them. But this is this is a new slide. I call this one that comes out of my intellectual junk drawer. I scribble it on whiteboards. I write it out on sheets of paper, take pictures of it, send it to clients. If the clients seem to like it enough, I go and get this thing put together. And what this is intended to show is why did we split it from, we had a software benchmark, what was the reason we did the split? And this chart is intended to show the reason for the split, because the infrastructure side if you look at the left-hand column of on-premise cloud, and then I'm just calling it seamless hybrid cloud. I hear it called cloud orchestration, whatever you want to call it. The old 2x2 matrices don't apply anymore because in the nature of this transition, there's kind of that half step, proof of concept, and now how do you get up and over? From EMC World, where I just came back, they talk, second platform, 2.5 and 3. So to them, 2.5 is that stutter step. So on the left-hand side, the challenge for the infrastructure apps, it's not only shifting how you monetize what you're doing, but they've got to bake in a ton of different new technologies that are required for infrastructure management in a cloud environment rather than an on-prem environment. So you have things like cloud orchestration, metering and billing, a service catalog, device-agnostic user panels, and data management. All these different things have to be up there. It's why we added ServiceNow into the infrastructure management benchmark, because they're taking a pretty good swipe at the traditional folks you think of down in that space or over in that space, the CA and BMC. Now, jump over to the app side, and it references Office 365 in there because it's really Microsoft. All that really had to happen there, and I have a liberal arts degree, engineers may twitch a little bit when I say this, but all that really had to happen there was a shift in how you delivered it. Whether you loaded it onto a desktop or you had them go through a web link and use it on the cloud, that was simple. So you get it up and over there, and now you've got to extend it for relevance and to enhance total customer value. So the things I put up there was use of Outlook. As a former small business owner, I never used Outlook because I didn't own a server. I just had laptops. If I had Office 365 and I got a push marketing message of, hey, do you want to trial Outlook, I probably would have trialed it. They've added Power BI in there, and it's also the industry verticalization. As the outcome buyer becomes more important, and that's for metering and billing on the infrastructure side, but as the outcome buyer becomes more important to the overall purchase decision, the classical industry marketing has to go an extra mile. You've got to drive it further down to the buyer's specific business. This is why at the large enterprise strategy-led consulting is in a resurgence in business transformation. And in the smaller level, in the smaller apps and the small medium enterprise, which is kind of where Office 365 is the workhorse of the productivity and visualization output for the mid-market space, you've got to drive it further into industries. So that's kind of other people used to call them my Jackson Pollock prints, but that's one that I finally got through editing. I would welcome any input or suggestions on how I could make that look a little cleaner or get the point across better. I didn't have it in the IM benchmark that I did Friday, but I did get it through, and I have it in this one, and you'll see it in coming quarters. This is a paid ad as to what we do and how we do it. The companies on the left are the companies that we track. We're interested. We'd love to hear about containerization. Do we do one on Docker, or do we do one around containers? We'd love to hear from you, or any firms you think ought to be added on there. Again, please send me email. We'd love to provide reports that you folks would find relevant, so you'll buy them. And then the benchmarks on the side, the middle one is the one we're talking about today. This we went through before. What you see here, applications, those are the color coding that's going to go on. We have app-centric. We've added Workday. In IM-centric, we added ServiceNow. They're not covered in this webinar. That's the most recent extension that we've done along with subscription and license revenue breakouts. So let's get into what's going on. Global economic indicators continue to soften, suggesting slowing application software activity. We take a look in these things. We take a look at the GDP by the regions that we break it out into for Americas, EMEA, and APJ. Americas is on the upswing, but EMEA and APJ are declining. And, there's questions, lots of concern with the Chinese economy. This isn't anything new. It's been written about quite a bit. The fact that you got to look at them as an export economy, almost two economies, the export and the consumer. The consumer side, which also includes business expansion, is running up private debt that's almost at pace with the total net value gain of their total GDP. That in the past has typically been an indicator that they're ready for a meltdown of some kind. So that's not to say it's going to happen in the next quarter, but suffice to say there's a lot of volatility over in some of the bellwethers in APJ. There's also EMEA's up and down depending on what's going on in the EU and whose sovereign debt's being assumed by whom. That's a challenge in its own right. So that's sort of the overarching theme. Now, as I told you, we broke out license streams and subscription streams, and it's more telling here than it was in the IM benchmark. But the license stream has dropped 15.7%, and subscription revenue jumped 48.2%. Now, smaller N, but one's going up and one's going down, and that trend we expect to see continue. Second one was particularly acute in the fourth quarter, was the rising strength of the U.S. dollar against the other currencies. There was a lot of elaboration about the dog eating the homework in all the various analyst calls about constant currency and as reported and the impact of this. And the more we get into subscriptions, it's one more variable that the analysts at TDR are going to have to keep track of as more and more of these firms get a greater share of their revenue out of long-term contracts where that deferred revenue, non-current or current deferred revenue line is going to wind up getting adjusted quarter to quarter. We try to use it to take a look at a tipping point between recurring revenue and net new sales, each quarter. So the book-to-bill ratio that was a bellwether for distributors back in, or still is, that kind of a model tipping point for the cloud-based revenue is something we want to take a look at. And now we got the wild card factor of adding in, having to do foreign exchange rate moves. But in the fourth quarter, they talked about a 5 to 8 point shift based on the currencies on these things. So it's something that we've got to do. And then as I discussed as I was talking about the headline, we have EMEA and APAC starting to slow up. So it seems as the U.S. is starting to gain a little traction and maybe start innovating again, the other geos are slowing up. So now we're going to get into a lot of the different bubble slides. This is taking just a look at total application revenue. Now we're going to unpack this into several different categories. We're going to get into product that we're going to subset to license and subscription. Then we're going to look at maintenance, and then we'll look at professional services. But as you can see here, a lot of the cloud guys, that's the green circle. Yeah, Kelsey, you want to take that?
Sure, yeah. So if you look over at the left, like Geoff was mentioning, the Pureplay cloud vendors, like NetSuite, Workday, they're really investing ahead of growth. So expanding in all ways, whether that's expanding their portfolio, expanding into new geos, industries, investing to expand their ecosystems. They're really just trying to meet the table stakes that the traditional players like Oracle and SAP have set. And those traditional players have the robust portfolios that they can integrate together by adding in analytics that they already have in those portfolios, tying those into line of business applications, creating suites out of separated line of business applications, like integrating sales, marketing, and services into kind of a customer engagement suite. Whereas, the smaller vendors like Workday or NetSuite would have to acquire, which costs a lot of money for such a small player, or invest in the R&D. And then you look at a company like Microsoft, who is really leading in this space in terms of volume by transitioning Office to the cloud. They've done a great job of moving that license base to subscription, and we think that SAP and Oracle are going to start to follow suit, start moving to the left as they transition their on-premise portfolios to the cloud, which is a lower margin business.
Yeah, and right now you'll see Oracle at the sort of the right-hand side of the spectrum. They're not seeing a lot of revenue growth. They're not seeing a lot of revenue growth right now, and that's because most of the cloud growth is being balanced by sort of contraction of the new software license business. But they do have very healthy margins right now, and that's as a result of I believe their maintenance contracts carry about a 94% gross margin. So we'll see them sort of move up as cloud takes over, but they'll also move a little bit to the left as those margins contract because cloud is a lower margin business.
So the next slide that you see here is taking a look at them in the aggregate. And by that, what I mean in the aggregate, we're looking at license revenue and we're looking at subscription revenue combined. So you can see the traditional vendors are all clustered around the y-axis there, while the pure plays are off in the upper right. And then there's a few of the outliers, and two, it's seasonal, so you don't really, that's all tax. That's TurboTax, so if you did your tax forms on that, that's why they get a bump. So they're interesting to look at, but they're a highly fluctuating firm. But you see the aggregates there, and you see Microsoft, a little bit more to the left because they've had more of the erosion of license moving over into the subscription base. Where we want to go next is to unbundle this, and we'll show you the 15 that we have for license only. So here you can see the green axis is our intersect of the averages, and I circled it on that slide just to call attention that, overall the product revenue growth was down 0.3%, but that's on a 15.7% decline of the license revenue. So you can see Tableau's up there on the right. They're more cloud-based. Dell is an errant entity or errant entrant because a lot of this is inorganic growth. So we have lumpy year-to-year compares for them. But for the most part, what you see here is the traditionals are declining a little bit faster than the software vendors as well. And
again, you'll see, as Geoff pointed out, those green lines are the axis of the averages. And you'll see Oracle kind of hovering around that average. But they're not as far down as Microsoft, and that's really because Oracle's transition to the cloud is still very young, and they haven't gotten as much traction as Microsoft has with transitioning Office, although just a few weeks ago Oracle did sort of put a stake in the ground saying that by October of this year they will have 95 of their products offered via the cloud. So we do expect that their position on this license chart to change as they really push everything on a cloud-first basis.
Okay, we're going to move next. This is a little bit rosier news. This is what we're used to seeing when we track the technology industry of all these hyper-growth segments. So this is coming back at it. The one thing we do know we need to add is that these bubble sizes vary from slide to slide. We're trying to figure out with the Excel jock who helps put these together for us of giving you a bubble that's 500 million so you can calibrate all these things. So don't compare the size of the bubbles necessarily as much as sort of where it is on that slide. But as you can see, you've got a lot of the high growth. Oracle's been pushing quite a bit, so their growth there is as much about the low denominator or the small base for the year-to-year growth rate on these things, which is why you see things where license revenue goes down 10%, cloud revenue's up 105, 110, those kinds of statements. But this pretty much paints the picture for the 15 we're able to track, that the future is in the subscription base. It's moving over to the cloud. It's a workflow by workflow variation. It needs to stitch back to the on-premise piece. As I said, one of the topics we're going to talk about later in the presentation is about how in-memory databases is somewhat of a trigger to the slow roll, if you will, of the Oracle and SAP lines. Okay, we will now move over to the maintenance chart. Now, the maintenance chart in some ways ties, it's a sort of a year lag to the license revenue chart we just gave you. The idea that you sell the license in year one, and year two you get about 20–25% of the license revenue stream in maintenance agreements. So you see that they're all sort of, hovering in. It's about a 3.5% growth on that, which isn't the 3.3. I'm having a hard time reading my own chart here as I sit in the room, but it's tepid, but it's in the positives. We would expect to see this start to decline. Meaghan?
And yeah, I just want to point out that while maintenance is tied heavily to licenses on a sort of a 12-month lag, we will see the declines accelerate a little bit in the near term as companies sort of offer customers these initiatives, which basically sacrifice maintenance revenue in order to get those customers to transition over to subscription contracts.
Right. They promote them as sort of a new marketing launch, but quite frankly, it's in reaction to what the key customers want. You know, hey, I'm locked into a 3-year deal. I want to move to the cloud now. What do you mean I can't break this deal? Fine, I'll go elsewhere. So it's as much a defensive hold strategy for the customer, even though you're moving them from license over to subscription. It's clearly something that to be customer focused, it has to be done, and it's just putting a marketing wrapper around something that's sort of just business common sense if you're trying to retain customers rather than anger them in the transition. Now, moving to services. Services, you see, is a little bit over the map. The two that I like to take a look at, and Kelsey will talk to you more about NetSuite, but you'll see in the blue, we're talking about IBM building out a partner-led model in the business units. This came out of a briefing we had from them 4 months ago or 3 months ago. We wrote a commentary on it about their organizational structural change. Global Business Services will indeed be the execution engine for the majority of the labor required in these services deals, but they're building out the kind of the business advisory consultancy element of IBM inside the commerce unit, so that they can talk business to business buyers, right? So they'll go hire somebody with 15 years of experience in the financial services end to be able to go in and talk the language of financial services and prove the value of what it is they can do, and then the engagement that will drag or help with the transformation over from an on-prem application environment over into a hybrid cloud environment, or using systems of engagement with cloud-enabled or built for cloud applications using agile development methodologies and all those new technologies and tools. This is where that transformation, for those who need the guidance, this is where it's going to come from. Now, the big challenge is really if you've got your direct arm doing these things, you've got your direct sales engine out there talking to these clients on a one-on-one basis, keeping an ear to the ground to try to retain the installed base, you got to have the antenna up for when they're looking to make the move and not be too wedded to the old world or you're going to lose them. And if it's a technology capability or a business knowledge, industry-specific competency that you lack, then you've got to have the partnerships with the global SIs, the Deloittes, the Bains, the McKinseys, and you got to know when to bring them in to help with that change transformation so you can drag the new subscription orders or whatever is going to come out of this transformation engagement. That's really, really critical. With that, Kelsey, talk about what NetSuite and Salesforce are.
Yeah, they're taking a, kind of a similar approach about what Geoff mentioned. It's talking the language of the customer. So for Salesforce, part of their growth is due to their acquisition of ExactTarget. They had a pretty large professional services business, but beyond that, what's going to sustain that growth is the fact that Salesforce is taking on this strategic advisory role. So they're building up internal expertise in regions and in industries, just trying to provide that tailored outcome for customers while also ensuring customer success. Salesforce is going to do as much as it can in-house, but partnerships like Geoff mentioned with the CNSI firms are going to play a critical role in that strategy. I'll get into that a little bit more later when we kind of dive into the scenario piece of this. And then when we look at NetSuite, again, similar strategy, organizing their professional services assets by industry to enable faster implementation cycles for customers, really trying to tailor professional services to customers' unique needs and make the customer feel like those unique needs are understood by the vendor, irregardless of whether the CNSI firm is involved.
Yeah, and so to add on to Geoff and Kelsey, while they get to talk about the guys that are doing really great things and seeing all this growth, I get to focus on those clustered around the axis. So we look at
they can't all be winners.
Yeah. So we look at some of those smaller firms, and it's really evident that they're clustered on the axis because they just don't have the in-house capabilities. So a lot of their customers are seeking professional service from their partners, and they have really big partner ecosystems. And then you see the big guys like SAP and Oracle, who they could have the capabilities if they wanted to, but they really do leave services as almost a white space to engage the SIs. So that's why you see them sitting there.
That's an excellent point. And really, before we get moving, we've given everything that's been going on in the papers for the last week, we probably should talk a little bit about Salesforce, just from the fact that supposedly they're seeking somebody's taking a hostile run at them, and they're trying to dive into the arms of somebody more friendly and familiar. SAP apparently isn't going to be that individual, based on CEO McDermott saying, what was it? They don't look for
commoditizing or declining companies when they make acquisitions.
Yeah, they don't look for commoditizing or declining companies when they make acquisitions. So this is kind of as you saw from the pictures. I'm a tad older than Kelsey and Meaghan. This is one of those times when you get to say "I told you so," because I've been talking about Salesforce for longer than people cared to hear me. That they had a missionary role of essentially, back before the turn of the century, building out a new deployment model. And so they were so focused, in my opinion, on how to tweak and optimize the cloud SaaS delivery model. They didn't have as much on the innovation layer. And typically the first to market, as an old mentor of mine would say it, you'd always find the first to market out blazing the trail, and the second to market would find them face dead with an arrow, face down with an arrow in their back. And if they had time, they'd pull the arrow out and bury them, or they just keep on going on the trail. So the question becomes, is this what's going to happen to Salesforce, given that they didn't necessarily have the breadth of the extensions that the better funded firms, such as a Microsoft, an Oracle, and an SAP, can bring to bear once Salesforce was out there proving the concept and getting customers over to a subscription-based model. So it'll be interesting to see who picks them up, if they get picked up at all. But clearly, if they've gone to the press and let it be known they're working with financial advisors to determine this, it sounds like their days as a standalone entity are going to come to a close. And with that, I don't know if we'll get questions on that. We certainly want to leave enough room for your questions. But let's get into the overarching themes that we want to talk about, and we each have one that we're going to address. So the first one, currency oscillations, greater impact on the multinationals, will be addressed by Meaghan. I'll pick up on the Inmemory database and try to explain why we're talking about databases in the applications webinar. And then Kelsey will talk to us about the emerging apps vendors and their partnering with SI. So with that, Meaghan, take it.
And so, yeah, Geoff dove into this. We'll go right into the slide. I know Geoff discussed at the beginning of the presentation a little bit about sort of, in 4Q, we're really seeing a lot of firms touting our results were all right in constant currency, but we really got hit by the foreign exchange. And we see that definitely as an impact because of the current market conditions, but we also want to highlight that this factor will really be amplified by the transition from license to subscription. As with the license model, the revenue coming in is recognized in the quarter immediately on the income statement, and it sort of only gets that one-time hit from the current exchange rates. Whereas with a subscription model, we're seeing companies carry the future subscriptions as deferred revenues on the balance sheet to be recognized in future quarters. And as the dollar strengthens, as it has been recently, companies are having to write down those deferred revenue buckets, and so they're not only getting hit in the current quarter where they're recognizing the revenue, they're also getting hit on the back end in those deferred revenues. Firms that are really seeing this hit right now are those that are based in the U.S. and doing a lot of business overseas. For instance, Progress Software, they're based in the U.S., but they have more than half of their revenue generated outside the U.S. So as they repatriate that currency in order to invest in R&D, as they have, I think it's 2/3 of their R&D locations are in North America, they need to bring that money back to invest it, but they're getting hit with the currency exchanges. And then we're seeing firms such as SAP who are based in Europe, and they're really actually benefiting from this right now. And that's because as they do business in the United States and they repatriate those dollars into euros, they're actually getting a bump. They're getting more euros per dollar. So it'll be interesting to watch these firms, how their current quarters are being hit, and also how their future revenues in the deferred revenue bucket will be hit moving forward.
Right. The only point I might add in there is another offshoot of this could be, as Meaghan stated, the repatriation of the money back into the U.S. is to keep it in those subsidiaries in other countries and perhaps do more M&A activity around the globe so you kind of keep the money in local dollars. Wasn't an idea of mine. It was one of my clients who brought that one up, and I think they were right. So I'm calling it my own idea now. So with that, let's jump to the second one. All right, in-memory databases. Why do I have these brought up here? And really, it's that example of Microsoft having the quick move of a desktop app up and over into the cloud. It's pretty simple. Now, if you're talking about all the big boys are running around with in-memory database technology, be it 12c, SAP HANA, IBM Watson, or the moves that Microsoft is making as well. And that is a much bigger lift, a much bigger cost for the rip and replace. There's far more legacy investment associated with that. So that database migration is going to be a much slower roll than it'll be for any of the consumerized desktop apps. So the reason why that in-memory database needs proofs of concepts is to justify the expense. Prove the business value. It was explained to me by Bill Schmarzo at EMC World in a briefing of doing the proof of concept and then showing the analytics lift. And I had to ask him to clarify analytics lift because I was thinking of it in terms of the cost of the technology deployment. And the way that he means it is the business value lift if you use analytics in your business applications. So what needs to happen then if you've got somebody with a large legacy install base? You need a cloud-based proof of concept that deploys the in-memory database technology in the cloud to deliver the output that, the output when it comes in can integrate into your existing on-prem back office functions. So that whole linchpin strategy, SAP customer, I think CEC, I think it's Customer Enterprise Cloud. We have it up here as Customer Experience Cloud. I tell SAP they need to work on their branding and products, quite frankly, but CEC has within that the marketing module from the Hybris acquisition, and the cloud-based deployment is using SAP HANA for the underlying analytics that are built into this system of engagement module. So that can be the proof of concept. Then they can stitch together some of the other cloud-based modules that work with it around CRM, service, and e-commerce. And over time, it can then justify the role of the on-premise deployment of R3 over to S4. It becomes the justification, and with that justification will then come the acceleration of subscription revenue streams. So this is why when we look at Oracle and SAP on those bubble charts, relative to Microsoft, we see this as what is the impediment. They need the proofs of concepts, and it's a bigger lift to move the sort of the data center centric applications over relative as compared to the notebook or desktop elements. And you see the same thing, IBM. They just did Watson Health, and they want to make clear you say health rather than health care, because a lot of this is things like Fitbits and things like this where you've got the personal experience generating the analytics. Well, they're taking the bedrock foundation of Watson as a compute and analytics engine and stitching together assets with Watson Health. Part of that initiative was picking up what we call, I think it's a fairly standard term, but I'll explain it a little bit, the community cloud, i.e. participants within a specific industry are kind of, anteing into the pot for the cloud that works just on their infrastructure. They picked that up out of, I believe it was based in Cleveland, Ohio. Add that together with the underlying Watson technologies, and they're going in and addressing those high-value markets where analytics, real-time analytics has an immediate documentable proof point, therefore justifying the investment in the expense. So with that, we'll move it over to Kelsey.
Thanks, Geoff. So Geoff was just talking about how some of the more mature vendors are kind of using database migration to drive application adoption. Now I'll talk about how the newer entrants or pure plays are partnering with CNSI firms to do the same. When I say newer entrants here, it's really relative to those traditional players like Microsoft, SAP, Oracle, IBM, who are just moving their apps to the cloud now, whereas pure play vendors like Salesforce, Workday, NetSuite, they came into the picture full on cloud, so how are they trying to drive adoption? So those newer entrants that I mentioned, their challenge is really that they don't have, coming into the market, the distribution, the brand recognition, the credibility within large enterprises relative to those traditional players. And really in the applications market, growth and adoption within the large enterprise space is really going to come at one of those traditional vendors' expense. The newer entrants are going to have to displace those legacy systems. So to solve these challenges, those newer entrants are partnering with CNSI firms, and those firms are able to give, like a Workday or a NetSuite, a larger distribution channel, and prove to enterprises that their solutions are enterprise ready, because the CNSI firms really are acting as those trusted advisors to large companies. They're taking the strategy-led approach to engagement, and they have long-standing relationships with those large enterprises. So if, the smaller guys can at least get their names in the conversations with an SAP and Oracle, they're at least now in competition with them, and the CNSI firms can handle any of the integration or the consulting aspects, especially as hybrid IT takes off, that the newer entrants really aren't equipped to handle. So if we take a look at some examples, like Workday. Workday's executives have noted that Workday is now, comfortable and has been successful within the mid-market and SMB space, and they're looking to expand their presence within large enterprises globally. And they've really gained a lot of traction, too, with some of the global services firms lately, both in terms of new and expanded partnerships, or those global firms are making Workday-focused acquisitions. So, for example, Accenture and CSC both expand their Workday practices within the last few quarters. Aon Hewitt acquired a firm called Cloud, which is the largest Workday-focused services firm in the UK. Similarly, PwC acquired a Canada-based Workday-focused services firm. So as I mentioned, these are the kind of partnerships that are really going to put Workday's name into those conversations with large enterprises, because they're going to have to displace Oracle or SAP or someone of the like, and those vendors have deep-rooted brand recognition and IT systems in place. The other example we have on here is Salesforce. Again, not exactly a newer entrant. They've been around for some odd 15 years, but they're obviously a lot larger than a Workday or NetSuite, but their challenge originally was the same, in that they came to market with a new delivery model, which is cloud, and they had to prove their credibility and really cloud's credibility to large enterprises. So they formed these partnerships with the large CNSI firms early on. But again, there's still a lot of large enterprises running on legacy systems. The transition isn't easy, especially if we're talking about something like ERP. So Salesforce is trying to displace those legacy systems and have companies run their entire business processes on Salesforce solutions. And as I mentioned before, they're taking the strategic advisory role to do so. But consulting partners are going to play a huge role in doing that, especially as Salesforce expands across multiple industries and expands into new regions. CNSI firms have expertise in those areas that Salesforce just doesn't have. So recently, Salesforce revamped their consulting partner program, improving training and program tiering, among other things, to enable faster advancement of partners. And it really just shows that Salesforce is putting an increasing emphasis on that ecosystem, which is especially important for them because they're kind of like in this middle-of-the-road position where they're still disrupting the traditional players, but they're also big enough now that they're at risk of being disrupted by whatever the next wave of app players is going to be.
And a point I would add here, and at the risk of sounding like I'm selling, one of the areas that we're looking at doing more research is on the qualitative aspects of how emerging technology vendors go approach these large SIs. The example I use is in the digital marketing services space. We have a new syndicated practice around that with Seth Ulinski running it, who speaks that language way better than I do. But there's about 1,900 different firms that are jockeying around for position there. So even if 10% of those 1,900 are approaching a Deloitte or an IBM or an HP, Accenture, that's 190 business plans and value propositions these people in the emerging technology space have to evaluate to determine who they're going to bet on when they go do strategy-led engagements. So we believe there's a shift in there. It's that move from Porter's 5 forces over to the notion of complementary assets. And how do you go approach them? So it would be advice and guidance to these little guys of, this is what you need to put into the business plan or the portfolio when you approach it, and vice versa. Are there any differences between the way the major SIs evaluate emerging technology? So if you're approaching the strategy-led firms, message this. If you're approaching the Indian Pureplays, the IPPs as they're called, go after them this way. And if you're going after the tech-led guys, the IBMs, the HPs, this is what they want to see. But there's a lot going on there, and it all boils down to the idea that the customer control was moved from IT over to the lines of business because you don't need to make that capital investment. You can do it up and over the cloud. And with that, we can turn it over to the questions.
Yeah, now I can take this first one I saw come in. It was about this most recent slide. So can you provide some examples of who you're referring to when you talk about CNSI firms?
Okay.
So from a broad overview, kind of the Accentures, the Deloittes, CSC, IBM Global Services, Geoff, who am I missing?
Cognizant, Wipro, Capgemini, Tata, Atos.
Yeah, I think a lot of the activity, though, that I've been seeing specifically would be around Accenture, Deloitte, IBM, CSC.
Okay. All right, so now, moving on to questions. So if you have any questions, please send them to the Q&A function now. Let's get started. So what would happen if the license and maintenance contracts were to flip to subscription overnight?
Do you want to take that one, Meaghan? That's what we're hoping to get on. So why don't you take that one?
I know this is Geoff's favorite question, so I'm feeling his thunder a little bit, I guess. But this is something that Geoff and I are actually looking into, and as soon as we have the time
to model it. Yeah.
We're hoping to get some modeling done around this question, actually, and actually put out a thought leadership piece. So let us know if you're interested in that. We'll have a reason to get it done sooner. But one thing we're looking at, especially with Oracle's most recent earnings sort of kicked this off, was Safra Catz mentioned that they were, for every $1 of license, they were getting another $1 of maintenance over the next 5 years, so which in our minds equals $2
over 5
years. Well, yeah, and
pass.
No, it was reversed.
No, pass was 5.
Are you sure?
Yeah.
Okay. I'll let you take this thing because now I'm going to mess it up.
Yeah, what they were saying is $1 of license when you add the maintenance that comes in after it over the next 4 years. So in 5 years, $1 sold in year 1 would aggregate up to $2 over 5 years, and yet in past, $1 in year 1 would equal $5. Now, what we don't have, the clues we don't have is what's an average, say, $1 million database install on a license basis. What do you pay for that as a pass layer? And then multiply it out times 5 versus the license layer. And we're even going to throw in having it on an all-red stack and having it on some Sunbox as well. But the difference there is those $2 are 94% gross margin. Those $5 are about 45% gross margin. So the cash in the Oracle pocket at the end of the day isn't a heck of a lot different. So unless it's a one-to-one exchange of a buck of on-prem is equal to $1 a pass, there's a whole bunch of other things that are going on there. So we want to try to make sure we get an accurate model. And again, our company name is Technology Business Research, not Technology Research. So it's not in our wheelhouse to be able to stitch together all the different components out of the price sheet. But once we get there, we'll then be able to just kind of flip the switch and say, okay, if all of their database revenue went from license to subscription overnight, based on these pass rates, this is what their revenue and profitability would look like if they didn't, lay anybody off or add any more bodies, just take the existing operating structure and shift the monetization, what will it look like? We look forward to getting there. As I said, we just haven't had the time to do it as a thought piece, but it's something that Meaghan and I both want to get done.
And I'll get it straight by the time we get to that project.
That's right. You'll be sure to model it correctly.
Yeah, and so the things we really want to get out of that are what is the difference in how many contracts these companies need to sign to reach the same dollar amount at the end of the day, and conversely, sort of what margins are they going to see in one side of the business versus the other. And right now, those margins for cloud are very low, partially because they're making the investment in infrastructure, sort of the investing ahead of growth that Kelsey had talked about for the cloud players earlier in this webinar. But at the end of the day, companies aren't going to be able to get their cloud margins up into the 90-something% that they're currently seeing in the on-premise business. So there's really going to be some pain there for those companies, and we're interested in looking at that.
Right. The Software AG CEO, I always mess up his name, so I'm not going to try. But the way he said it at a briefing is that the shift to the cloud is trying to turn software companies into CapEx companies by making them take the risk on the data center cost to then sell their software IP out over their own data center. So some are doing it, some aren't. Microsoft in their earnings gave some clues to being very detailed on the utilization rate by workload, so that you can see an ability to have very granular chargeback of data center construction around all the various subscription apps that they're doing. Well, let's see what were the other questions that we had here.
Next question. You mentioned Oracle not having the same traction as Microsoft. So how has Microsoft been able to transition its customer base to the cloud more quickly than its peers?
Oh, no, they're pointing to me. I didn't know if Kelsey wanted to take that one.
This is your wheelhouse, Geoff.
It's my wheelhouse? Okay. Well, what we were getting at there is the relative simplicity of moving what I'll call consumerized apps. We've heard about the consumerization of IT, and Office was the ultimate consumerized application for business productivity, and that's the first thing they moved over, and now they're extending it outward, whereas for Oracle, everything writes to their database. So the first thing you got to get moved, in theory, is the database, and that's going to be the slow roll, because that's a bigger investment shift for existing accounts to move from all the assets that have been built, all the bespoke applications, you name it, that they've got built on an on-premise basis, and do they really want to move all that over to the cloud? Do they want to have it as a hybrid cloud? So that's where the PaaS layer is strategic for the large multi-line software vendors, because on the PaaS layer you've got the app dev sandbox for proof of concept test, how much easier is it to write to the new database, blah, blah, blah. All those things that they can do in a fast, what do they call it, fast failure model, where you're using OpEx money through cloud subscriptions to do the development and test work. Then you can test a go live if you like it. Then you can decide if you want to now start ripping and replacing and doing the roll over to the new platform technology that is glued together, if you will, by in-memory databases, as well as let's not discount unstructured databases around Hadoop, but that whole configuration and consolidation. What's the question? Can you provide any thoughts you have around HP software and the company split? That's an interesting question. I'll be honest and say I've been tracking HP less in this new role, looking specifically at software given their legacy iron, and I think I'm giving you straight opinion on this one, but I think part of what that is if you think of the risk, if you think of it as it's a very risky industry to be in traditional enterprise and to be in, for lack of a better word, the increasingly commoditized nature of, I'll just say ubiquitously devices, and by that I mean from the desktop, the laptop, the tablet, the smartphone, and whatever Internet of Things sensors are coming. So devices versus data center. And it could very well be they drove the split such that if one was successful, the other one was not, that it wouldn't drag them down. If you think of Carly Fiorina, when she was there was a Fortune article that didn't didn't paint her favorably for essentially squandering the profit opportunity that came out of printer and supplies from the inkjet and laserjet division to bolster up the legacy test and measurement instrumentation. That that should have been discarded sooner, and that the profits were being sucked away for an ailing, declining business that they should have just exited. And the compare there would be IBM. Does not hang on to business lines very long if they don't think they're moving, right? We've got the proof cases that go all the way back to typewriters and printers and disk drives. Well, they're still in disk, but PBXs, I take that back. Rome, they got that, and then they jumped it. Printers, and now servers, and now they've jumped over to a licensing model. So they're much more nimble based on commoditization eroding the profit pools. As Ramadi said, they got rid of $7 billion in revenue and gained $500 million, or got rid of $500 million in losses. So she, used the term that those were hollow calories. So I think the split is perhaps to make sure that each stands on their own merits, rather than a Siamese twin where if one gets sick, they both get sick. It could be an idea that in this, challenging time, they want to keep them separate. Whereas, and compare and contrast that to the way EMC's doing it with the Federation, where their core, they know that the commoditization is coming there, and their, flash storage is kind of the key net new innovation there. Is spinning disk kind of sinks below the commoditization line, particularly as software virtualizes it. So they kind of know their core is going to have a challenge, so they want to keep these federated pieces close together, almost as poison pills, that if you want to try to buy the ailing component here, or the increasingly commoditizing component, you got to pick up the high value things that still have a lot of cachet in the new world order around VMware, increasingly less, and Pivotal, which is clearly the new shiny object on the EMC Federation banner.
All right, I think we only have one last question here. Who do you think will acquire Salesforce, if anyone?
Well, I thought it was going to be Microsoft, so I'm all wet. So Meaghan, you were working on that while I was away.
Yeah, so this has been sort of a hot topic around the office, and I know there's been a few different sort of things that have come out about it. I mean, there's the consideration that it might actually be that Salesforce is looking to acquire another company. I think they're
minority interest in Sage.
Exactly, a minority interest in Sage is sort of the one that's really going around. And while that is a possibility, I think if we're going to look at sort of the big dogs that could really benefit from acquiring Salesforce, there was SAP who flat out said no, we're not doing that. There was Microsoft who said they were evaluating a bid, but recently have come out to say no, we're just kidding, we're not. So in my mind, that really leaves Oracle as the last option, and I think it's a good option. Salesforce is operating at a loss, and they really can't get out of that hole themselves, I don't think. I know Kelsey's definitely, correct me if I'm wrong, but their direct Salesforce is really keeping them from operating at a profit.
Yeah.
Salesforce?
Yeah.
Salesforce is Salesforce. Is
They spend way too much in sales and marketing right now to think about turning a profit, but, well, I mean, they are thinking about it. They know they have to eventually, but they're going to really have to wean down that sales and marketing expense, and the kind of number that we've put in the sky for Salesforce making a profit is that they'll have to reach $10 billion in annual revenue before that's even a possibility.
Which is more than double what they are now. So,
yeah, so
that's a ways down the road.
That is the I have friends in the venture capital community who read business plans, and the joke one of them uses is that idea of the snake charmer from old black and white grade B movies of what's the big leap of faith in the business plan? When do the snakes come out? And where the snakes come out in software as a service is the idea that you go from blue suit selling to add to cart selling, so therefore the renewal's cheap. Well, if that's going to work, then what you need to be doing is taking a look at the tipping point within your business mix, which is why we try to feather out the current deferred, to try to take a look each quarter, how much is recurring revenue versus net new sales, because that truly is going to take a look at the sales expense to revenue of new business. And so the problem then becomes, once you reach that tipping point, you have to turn to a very powerful function within your organization, which would be the head of sales, and say, you've got to start downsizing your fiefdom because we don't need it anymore because we're going to add to cart renewals and we need fewer of you. And that's a tough, tough political sell. And if you don't catch it right, you know, you're tailgating at 110 miles an hour in a hyper growth scenario. So you can hide a lot of operational sins. Wall Street's giving you a hall pass on profitability, as Joe Tucci said it when he was grumbling about Wall Street not liking their profitability numbers right now, talking about Amazon. But that, you know, that's a big shift there. So if it's somebody that thinks they can grab it and scale it even further, that would make sense. And, you know, if that's the case, you've got, Larry Ellison is certainly reorganizing Oracle to party like it's 1999 again when he did a massive transformation of that Salesforce under Ray Lane. Might have even been earlier than that. I might be dating myself. But they seem to be going back to the future in terms of the sales strategy, which is to aggressively go out and knock off Workday and Salesforce. And what better way to knock them off than buying them? So it was my opinion there was probably Oracle who took the run. Salesforce then got a case of the yips and is looking for a sort of a white knight to come in to keep them out of there. But if they can't find one, and Oracle wants to spend the money, they'll wind up with them, I would think.
And I think there's a lot of places where Salesforce would fit well into Oracle.
Sure.
I mean,
culturally, though?
Culturally, yes.
Really?
Oracle and Salesforce, they both have
better than Microsoft?
Better than Microsoft. Both Oracle and Salesforce have very similar sales strategies, though Oracle is bigger and can absorb the cost of them better.
Right.
They're both very set on direct selling versus other channel-led vendors. And really, the thing that's eating away at me is Larry's decision to put both Safra and Mark as co-CEOs a few quarters ago. And so he's really neglecting to point out one person as the future heir to the throne. And in my mind, that could be Mark Benioff. He has a
yeah.
I mean, Safra is the money person.
Herd's the product guy.
Herd's the product guy, but I mean, he left HP for reasons, and I don't know that he still has a clear vision on cloud either. Benioff clearly does have a clear vision on cloud. Oracle
wants to be in the cloud. Yeah. We've heard many times it's cloud-first strategy. That's it. They came out and said at the end of October, 95 of their offerings will be in the cloud.
Right. What credibility do they have in the cloud if when cloud first, started coming onto their horizon, they denounced the whole thing and they said cloud was stupid and it would never take off. Yet here they are saying they're moving their portfolio to the cloud. So, I mean, it would give them at least credibility with their customers saying, like, look, we're serious about cloud.
And that's the thing. They have the database in Java as the basis of their platform as a service offering that they released a few months ago. But, I mean, platform as a service is really still a small base. Salesforce is built on Oracle. I mean,
yeah.
So if there wouldn't be that much integration, Oracle would just have to sort of eat the R&D they've put forward into their own platform as a service. And I think that Salesforce is established enough that it's worth it for them. They have the cash on the balance sheet, and they've recently, they just raised another, $10 billion, I believe. So they've got like $60 billion in assets right now, current assets, that is. So they have the resources to buy the company, and I don't think it's a bad move if it does go through.
Well, ladies and gentlemen, this is the top of the hour on the webinar, but hopefully what you got to see in the last few minutes is why I enjoy coming to work every day. This is what happens to me on a regular basis when I talk with Kelsey and Meaghan. We just get into rapid-fire discussion. Usually I'm trying to scribble on a whiteboard. It's what makes it fun to come to work. I'd ask, I know we're getting late, but if you could hang on enough and give us the feedback on the webinar, and if there's things either that you think, stop belaboring this or add this, these webinars are for you. We can only get better if you give us the input, and we would certainly welcome your input on how we did, both in what we covered and how we covered it. And thank you for your time.